You're scrolling through your investment app at 7 a.m., coffee in hand, and your portfolio is down another 8% overnight. Your stomach drops. Your coworker sold everything last week and won't stop talking about it. Your mom's calling asking if she should pull out her retirement money. And every financial headline is screaming the same thing: get out now before it's too late. But here's what nobody's telling you, and what I'm about to share could be the difference between losing everything and setting yourself up for generational wealth. My name is Nick, and I spend way too much time analyzing market crashes, reading economic reports at 2 a.m., and figuring out how regular people can actually build wealth when everyone else is panicking. If you're someone who's terrified of checking your portfolio right now, or you've been too scared to start investing because of all this chaos, or you're just sick of feeling like the financial system is rigged against you, you're in the right place. Make sure to smash that subscribe button because we're about to break down exactly what's happening, why it's happening, and most importantly, how you can actually profit from this mess while everyone else is running for the exits. And look, I know you've probably watched 10 videos about this already, but stick with me because what I'm about to show you about the 2026 crash is something most financial channels are completely missing. So, let's talk about what's actually happening right now in 2026. The S&P 500 is down 31% from its peak in January. Tech stocks? Absolute bloodbath, down over 40%. Your neighbor who wouldn't shut up about his Nvidia gains at the barbecue last summer? Yeah, he's not talking anymore. And here's the thing. This isn't some random market hiccup. This isn't just normal volatility. There are 3 very specific triggers behind this crash, and they all connect to decisions being made right now in Washington. Now, before anyone jumps down to the comments screaming about politics, pump the brakes. I don't care if you love the current administration or hate it. I'm not here to debate politics. I'm here to make money, and I'm assuming you are too. So let's look at this like investors, not like we're sitting around Thanksgiving dinner arguing with Uncle Bob. Here's what most people don't realize about tariffs. They're basically a tax on you. Not on China, not on Mexico, on you. Let me explain with some real math. In early 2026, the administration doubled down on what they're calling economic patriotism. They slapped a 60% tariff on Chinese imports, a 35% tariff on Mexican goods, and expanded tariffs across electronics, automotive parts, and even agricultural products. Sounds great, right? Stick it to the foreign countries, bring jobs back to America. Except here's the problem that nobody wants to admit. American companies that import these goods don't just eat the cost. They pass it directly to you. Let's say you're buying a new laptop that used to cost $1,000. The components come from China, so now there's a 60% tariff on them. That laptop now costs $1,600. That's an extra $600 out of your pocket. Multiply that across cars, appliances, clothing, electronics, everything that gets imported, and the average American household is now paying an estimated $4,200 more per year just in higher prices. But wait, it gets worse. Other countries aren't just sitting there taking it. The European Union hit back with 40% tariffs on American exports. China imposed 75% tariffs on U.S. agricultural products, which is devastating farmers in the Midwest. Mexico retaliated with 50% tariffs on American manufacturing goods. Now you might be thinking, okay, Nick, but isn't this just temporary pain for long-term gain? Won't we bring manufacturing back to America? Here's the brutal truth. It takes 5 to 10 years to build the infrastructure to manufacture complex goods domestically. You can't just snap your fingers and build a semiconductor factory in Ohio. Meanwhile, you're paying 40 to 60% more for everything right now. And here's what really makes my blood boil. We've seen this exact scenario before. In 1930, the Smoot-Hawley Tariff Act did the exact same thing. It was supposed to protect American workers. Instead, it helped trigger the Great Depression. Global trade collapsed by 66%. Unemployment hit 25%. It took over a decade to recover. The stock market is crashing right now because institutional investors, the big money, knows this playbook. They've studied history. They see what's coming, so they're selling everything before it gets worse. Okay, here's where it gets really interesting, and this is the part that should genuinely terrify you. The U.S. national debt just crossed $40 trillion in 2026. Let that sink in. $40 trillion. Now, when interest rates were near zero, that debt was manageable. It was like having a massive credit card balance at 0% APR. Not great, but not killing you either. But here's the problem. Interest rates are still hovering around 4.5% to 5% because inflation hasn't been fully tamed yet. Let me break down the math because this is absolutely insane. At 5% interest on $40 trillion, the U.S. government is paying $2 trillion per year just in interest payments. Not reducing the debt, not investing in infrastructure, just servicing the interest. To put that in perspective, that's more than the entire defense budget. That's more than Medicare. The government is spending more on interest than almost any actual program. And here's the kicker. Tax revenue in 2026 is around $5 trillion. That means 40% of every single tax dollar collected is going straight to interest payments. Nothing else, just keeping the debt from exploding. So what does the government do? They have two terrible options. Either raise taxes significantly, which slows economic growth and tanks the stock market, or cut spending dramatically, which also slows economic growth and tanks the stock market. The market is crashing because investors realize we're in a fiscal trap with no easy way out. It's like watching a slow-motion car crash and everyone's trying to get out of the vehicle before impact. Now here's where things get psychological, and this is what separates people who lose money from people who make life-changing wealth during crashes. The Federal Reserve is stuck between a rock and a hard place. Inflation is still running at 3.8%, higher than their 2% target. Normally, they'd keep interest rates high to crush inflation, but if they do that, they risk pushing the economy into a deep recession because borrowing costs are so high that businesses stop expanding and consumers stop spending. On the flip side, if they cut interest rates to prevent a recession, inflation could roar back even worse than before, and inflation is a hidden tax that destroys your purchasing power. Look, here's the thing that drives me crazy about how people think about inflation. You might think, oh, 3.8% inflation, that's not that bad. But let me show you the real impact with an example that'll make you sick. Let's say you have $50,000 sitting in a savings account earning 0.5% interest. With 3.8% inflation, you're losing 3.3% of your purchasing power every single year. In just 5 years, that $50,000 has the purchasing power of only $41,500 in today's dollars. You just lost $8,500 in real wealth by doing absolutely nothing wrong, just by holding cash. This is why the market is freaking out. The Fed has no good options. Every path leads to pain, and investors hate uncertainty more than they hate bad news.
Now, you might be thinking, okay, Nick, this all sounds terrible. Should I just sell everything and hide cash under my mattress? And this is where we need to talk about the most important concept in investing. Something that will literally determine whether you retire wealthy or struggle financially for the rest of your life. Every single stock market crash in U.S. history has been followed by a recovery that reached new all-time highs. Every single one. The Great Depression? The market eventually recovered and went on to hit record highs. The 2000 dot-com crash? Recovered. The 2008 financial crisis? Recovered. The 2020 COVID crash not only recovered but hit new highs within 18 months. Here's a stat that should be tattooed on every investor's brain. If you invested $10,000 in the S&P 500 in 2008 at the peak before the crash, and you did absolutely nothing, you just held through all the panic, all the fear, all the experts telling you to sell, that $10,000 would be worth over $40,000 today. But if you sold in a panic in March 2009, when everyone was screaming that the financial system was collapsing, you would have locked in a 50% loss and missed the entire recovery. Let me say that again, because this is critical. The people who lost money in 2008 weren't the ones who stayed invested. It was the ones who sold at the bottom and never got back in. All right, here's the part you've been waiting for. I'm not a financial advisor. You need to do your own research and make your own decisions. But I've personally invested through multiple crashes, and here's exactly what I'm doing right now and what you should seriously consider. Before you invest a single dollar in this crash, you need to have the basics covered. I'm talking about 3 to 6 months of living expenses in an emergency fund. If you lose your job tomorrow, you need to be able to survive without touching your investments. Second, pay off any debt with an interest rate above 7%. Credit card debt at 22%? That needs to go before you invest a penny. Car loan at 9%? Pay it off. You cannot outinvest high-interest debt. The math just doesn't work. Now, assuming you've got those covered, let's talk about the opportunity in front of you. Here's what smart investors are doing right now. They're buying consistently every single week or month, regardless of what the market does. Let me show you why this works with real numbers. Let's say you have $12,000 to invest this year. Instead of trying to time the perfect bottom, which is literally impossible, you invest $1,000 per month. In months when the market is down, you buy more shares. In months when it's up, you buy fewer shares. Over time, you're averaging out your cost and removing emotion from the equation. Historical data shows that dollar-cost averaging during bear markets produces significantly better returns than trying to time the market. We're talking 30 to 50% better returns over a 10-year period. Look, when the market crashes, everything goes down, both the garbage companies and the incredible businesses. That's your opportunity. I'm talking about companies with strong balance sheets, consistent revenue, low debt, and products that people need regardless of the economy. Think about companies that provide essential services, healthcare, consumer staples, and technology that isn't going anywhere. These companies are currently on sale. It's like walking into your favorite store and everything is 30 to 40% off. You don't walk out, you load up the cart. Here's a mistake I see all the time. People think diversification means owning 50 different stocks. That's not diversification, that's confusion. Real diversification means spreading your investments across different asset classes. I'm talking stocks, bonds, real estate investment trusts, maybe some precious metals like gold, and for those who understand the risk, even a small allocation to cryptocurrency. My personal portfolio right now, about 70% stocks, focused on index funds and quality individual companies, 20% real estate and REITs, 5% bonds, and 5% in gold and Bitcoin. That's what works for me based on my risk tolerance and timeline. Here's the thing that separates wealthy investors from everyone else. It's not intelligence, it's not luck, and it's not having more money to start with. It's psychology. When everyone is panicking and selling, you need to be the person who stays calm and buys. When everyone is greedy and buying at all-time highs, you need to be the person taking profits. Warren Buffett has a quote that everyone knows, but nobody actually follows. Be fearful when others are greedy, and greedy when others are fearful. Right now, in 2026, everyone is fearful. That means this is the time to be greedy, not reckless, but strategically aggressive. The 2026 crash is real. The pain is real. The fear you're feeling is completely valid. But crashes are not the end. They're a transfer of wealth from people who panic to people who stay disciplined. History is incredibly clear on this. Every major market downturn has been followed by a recovery that created enormous wealth for those who had the courage to invest during the chaos. 10 years from now, you'll look back at 2026 as either the year you panicked and sold everything, or the year you set yourself up for financial freedom by investing when everyone else was running scared. The choice is yours, but I know which side I'm on, and I know which side will create generational wealth. If you want to learn exactly how I'm building wealth in 2026 despite the chaos, I've got another video breaking down my complete investment strategy step by step. But before you click, make sure you hit that subscribe button because we're going deep on wealth building strategies that actually work in the real world. I'll see you in the next one. Stay smart, stay disciplined, and stay wealthy.